Hello and welcome to another week of your Mortgage Market Movers Weekly, where we are detailing everything that's going on in the macroeconomy to help you make better home buying decisions. This week's 30-year fix is sitting at a 6.11, which is up once again just one tick from last week's 6.10. All right, this week we have data drops, both labor and inflation information. So we're going to dive into that and everything else that's going on in the economy right here, right now when we get into the charts. So let's go. We've been keeping a very careful eye on the U.S. 10-year, and it broke above this 4.2 kind of ceiling right here. It was hovering there. It looks like it is coming back down, so the bond market is picking up a little bit. So 10-year is coming down, which is good news. Usually when 10-year comes down right, then lenders have a little bit more leeway to drop mortgage interest rates. Of course, they don't have to, but mortgage interest rates are typically keyed off of the 10-year yield. So we do want to see it sustain below 4.2 and hopefully drift even lower as the bond market, as we can see here, starts to get a bid, picked up a little bit more, and people are buying more government bonds. All right, let's see. On the economic calendar, we had, as of Tuesday, February 10th, core retail sales, and those were not great. So looks like no increase. There was an expected increase of 0.3%. So people are not spending money right now. Let's see. This is delayed data too. So this was delayed 27 days due to a government shutdown. So I guess this was January data, I believe. Yeah. I think that was January data. Maybe December. Anyway, delayed data, retail sales, not great. So Wednesday, we will have non-farm employment change, average hourly earnings, and unemployment rate. This is going to let us know what the Fed is thinking of the labor side of the market. Remember, there are two key mandates for the Fed members to look into and try to sustain in order to determine what they are going to set the federal funds rate at. And that is maintaining a solid labor market and trying to get inflation to come down. They had a 2% goal. We are not at 2%. So we're hoping for good labor data here on Wednesday, and then the CPI print, so consumer price index, for this to kind of hopefully come down a little bit. And if inflation can come down, and I mean, if labor gets worse, Feds are going to probably want to cut rates. But if labor sustains and inflation starts to come down, I could see them also wanting to potentially do a cut. But if this inflation is getting a little stickier, which it has been decently sticky, then I don't know. I mean, we'll have to see, but it is not looking great for rate cuts, which honestly doesn't even matter too much for us. You know, like we always say, it's not about the Fed rate cuts. I think it's more important to look at inflation to see what the 10-year yield is going to do. But common, mistake to think that the Feds cut mortgage interest rates. They do not. But we are pricing in an 80% pause for March, and then potentially almost a 50% chance of a cut. Oh, well, no. So it's more than likely going to be a cut. It looks like only a 24% chance of a pause, 49% chance of one cut, and then 23% chance of a jumbo cut. So more than likely just looking at this one cut, and we will see how these numbers change after labor and inflation come in. And then another potential cut around September or October. All right. So we have average hourly earnings, non-farm employment change, and unemployment rate. Like I said, is this delayed information also? Yeah, delayed 5 days. So not too bad. But it's important to keep in mind in this non-farm employment change, the Fed has said that they are going to revise this number down by 60,000 because of the government shutdown. So, right, if this comes in at 66,000, then the actual number is only going to be 6,000, which is way worse than 50,000. But definitely not, what we want to see as far as adding jobs into the economy. Unemployment rate, we are looking at a potential 4.4%. And then unemployment claims on Thursday, expected 222, previous 231K. We also have the 10-year bond, so this will probably be interesting to look at on Wednesday at 1:01 p.m. Not 1 o'clock p.m., but 1:01. Mortgage delinquencies, if this does come out, which I don't know why that's tentative, but if it does come out, that's interesting to look at. Existing home sales is also interesting to look at. And then, of course, CPI, that is the big data point that we want to look at, only delayed by 2 days. We want to see for consumers is our prices coming down. All right, so we have core month over month, and non-core month over month, and then year over year. Expecting a 2.5 for year over year and a 0.3 for both core and non-core. So a beat would definitely help to shoot the bond market up, which would consequently bring the 10-year yield down. So hoping for that. Like I said, a 6.11 up a tick from 6.10. And we have a little trend right now. And of course, this is applications whenever we look at this average. So I wouldn't, almost take it with a grain of salt, because a lot can go into that. What is on the application. Definitely depends on the lender. Depends. I don't know if this is with like any kind of discount points, right? So I would imagine that it is if they're literally just looking at applications and aggregating that data. But we have seen this little uptick from 6.06. It's not much, but it is a very, very slow creep up. But, like I said, that 10-year yield is coming down, so I think that lenders will have some more leeway to drop their mortgage rates a little bit. Hopefully, anyway, Let's see. Again, we will see how this changes Friday, and we'll take a look next week to see if the odds of rate cuts change at all. But that's all I got for you this week. So if anyone has any comments, questions, or concerns, visit us at www.mortgagesbylinda or reach out to us at 877-TEAM-MBL. Have a great week, everyone. Bye.